I would like to welcome you all to our today's Insurance Committee webinar. This time we are going to speak about synthetic securitization, which is now also a possibility of cooperation between insurance and banks, as you will hear now. Now, Alan Ball from Texel will first give us an introduction and overview. How is synthetic securitization done when working with the insurance industry?
By way of introduction to myself, I'm an insurance broker at Texel, and I sit in the structured and bespoke solutions team, where one of our focuses is on arranging insurer participations in synthetic securitizations for our banking clients. Now, this is a developing area of the market, and the transactions are subject to some quite detailed regulatory and technical provisions. So the aim of today's session, and particularly my introductory section, is to really give a high-level introduction to the area and hopefully leave the audience with, I guess, a more intuitive understanding of these transactions and why they make a lot of sense for banks, but also why they can make a lot of sense for the insurance market as well. So I set out a brief summary of the points I'm going to cover, and I don't propose to read out every slide. And while this is an introductory section, if anyone does have any more technical questions, then I'm very happy to field them towards the end of the session when I know there'll be a Q&A. If we can move on to the next slide, please, Celia. Great, thanks. So a key point I want to bring out here is that synthetic securitization is by no means a new concept. This has been a core regulatory capital management tool used by banks, and some of the first transactions executed date back as long as 20 years. Now, if I kind of put my underwriter hat on, and I'm very mindful that when we approach insurers and we ask them to look at this area, if you're asking an insurer to look at a new asset class, structure, or type of transaction, there can be sometimes a little nervousness or apprehensiveness about looking at a new area, because the insurers want to understand, well, what's the history of this market? And it's actually been a source of comfort in some of our conversations with insurers for them to learn that actually this is a very well-established market that has run effectively for a number of years and performed very well. And it's actually a market that could carry on existing without the participation of insurers. But the point I really want to make is that it's an area where, for reasons I'll come on to later, insurers can add a lot of value to their core banking clients. But also this market, I think, can add a lot of value to insurers in terms of the development of their overall business and relationship. So Catherine's got some statistics later on regarding the volume of the transactions executed in this space, but just a kind of a short highlight here. In 2018, there was 49 transactions executed relating to over 104 billion euros of credit exposure. The banks routinely use these transactions across a range of asset classes, so from trade finance to large corporate lending, project financing, asset-backed lending, and the other classes listed there. And a number of banks execute these transactions on a programmatic basis, which means that they have platforms already set up where these transactions are executed on a routine, quite often annually or more than annual basis. The other point to note, which I alluded to at the outset, is that the transactions are subject to a lot of detailed regulatory provision and subject to regulator oversight. And I think that kind of speaks to how well established the area is. You don't get the detailed regulations and technical rules that apply to an area like synthetic securitization if it's an untested area that's popped up overnight. So that hopefully, again, is a source of comfort as to how well established this marketplace is. If we can move on to the next slide, please. So stepping back to very first principles, I find it's quite helpful to look at the regulatory definition of securitization when we're talking about this area for the first time. So the CRR defines a securitization as a transaction whereby the credit risk associated with an exposure or a pool of exposures is tranched, and the subordination of those tranches determines the distribution of losses during the life of the transaction. And it's those two first points that I think are really critical to the concept of a securitization that I'll focus on. Cecilia, if you go on to the next slide, please. So if you imagine a bank holds $1 billion portfolio of loans, and these loans can be for any asset class, corporate lending, SME lending, trade financing, as you alluded to. Now imagine that the bank enters into an agreement or a transaction structure whereby one counterparty agrees to assume the first 5% of the losses associated with that portfolio, and then another counterparty agrees to assume, say, 5 to 6% of the losses associated with that portfolio. Well, in entering into those agreements, whereby the counterparties are provided credit protection, and that could be in the form of an insurance policy, a guarantee, CDS, we'll come on to that later. What you've done is you've created tranching, which is the first criteria, and then you've also created a scheme where you have an allocation of losses according to subordination. If you look at the diagram, you see counterparty 1 will assume the first 5% of losses, and counterparty 2 will assume the first next 5 to 6% of losses. Now you could easily have a transaction where you have tranching where there's only one counterparty. The key is that you have tranching of some sort, and the losses are allocated in accordance with the subordination that exists between those tranches. Can you go on to the next slide, please? So I'm mindful that we talk about synthetic securitization, and people often think, well, why is this called a synthetic securitization? A joke I often make is that I'm not sure that many things really become better when they become synthetic, but maybe securitization is one of those areas. The reason why you have the distinction between synthetic securitization and traditional securitization is the regulations contemplate two types. So you have the traditional securitization, which involves a transfer of the underlying loans or economic exposures to a third party. This is usually by a sale of the assets. These types of securitization are quite often called a quote-unquote true sale securitization, whereas the synthetic securitization transfers the risk through the use of either a credit derivative or a guarantee, such as an insurance policy or a financial guarantee or another instrument. So just to compare and contrast these two structures very briefly, we can go on to the next slide, please, Celia. So this is a true sale securitization, and I suspect some of the audience may be familiar with a structure that looks very much like this. You can see here, the bank which owned the portfolio of loans has transferred the risk by actually transferring the loans themselves to a special purpose vehicle. That special purpose vehicle has funded the purchase of those loans through the issue of debt in the form of various notes to investors. Now, the allocation of losses amongst those notes is a function of the performance of the loans, and the tranching and the subordination of those notes determines the allocation of losses. So you can see that we still tick the two fundamental requirements of a securitization. We have tranching and we have losses according to subordination. And that's a true sale traditional securitization. If you go on to the next slide, you see this is a synthetic securitization. The overall dynamics are similar in that you effectively have a transfer of credit risk, but the way the transfer of credit risk is achieved is through a guarantee or a CDS or an insurance policy. You can see here we have the counterparties agreeing to assume a pre-agreed amount of losses in respect of an underlying financial exposure, and they're writing either a guarantee or an insurance policy directly to the bank. Again, you have the tranching and the losses according to subordination. And stepping back, the point I really want to bring out here is hopefully you see how similar what happens at the macro level in a synthetic securitization. You can see how similar that is to what happens routinely in an insurance contract or an insurance arrangement. You have a counterparty providing credit protection. Under the terms of that credit protection, the counterparty has agreed to assume a pre-agreed portion of losses on an underlying financial exposure for the bank. So hopefully that gives a sense of how these transactions operate at kind of the principles-based level. And if you go on to the next slide, Celia. I'll just talk a bit about the reasons why banks execute these transactions. The motivations are very similar to the reasons why banks will enter into a regular insurance policy for credit exposure, credit risk mitigation, management of the balance sheet in terms of counterparty, sectoral limit exposures. But a really key driver are the regulatory capital benefits that banks can realize from these transactions. So in order to realize regulatory capital benefits from a synthetic securitization, there are detailed requirements set out in the CRR and other amending legislation. But a key condition or a key test that has to be satisfied is the transfer of what's called significant credit risk associated with the relevant portfolio to a third party. Now this requirement is so key that these transactions are often referred to as significant risk transfer transactions, or SRT transactions for short, because this is really the core principle at play when executing a synthetic securitization. Now, as to exactly how you determine whether significant risk transfer has happened, there are tests that are set out in the capital requirements regulation, and they're broadly based on the amount of the exposure value that the bank continues to hold post the synthetic securitization, or the amount of risk-weighted assets associated with the underlying pool that the bank continues to hold post-securitization. But a key point to highlight here is that if you can satisfy that test, the risk weighting on the retained exposure, so this is the exposure in the portfolio that hasn't been transferred to a third party, the risk weighting on the retained exposure can be as low as 15%, which can give rise to very significant, very material regulatory capital benefits. The other point to add here is that the regulatory capital benefit, that's to say the reduction in risk-weighted assets associated with the portfolio, must be commensurate with the risk transfer. And what this point is really getting at is that there's different ways to structure these transactions, and you can have a number of various involved or complicated provisions in the contract, but the substance of the transaction must be that significant credit risk has ultimately been transferred to a third party and is in no way passed back to the bank, so that the reduction in the RWA held with the portfolio is meaningful and truly reflective of the credit risk that is now retained. So I've set out a very, very simplified example on the next slide, please, Celia. So if we go back to the original example, if you imagine a bank holds on its balance sheet a $1 billion loan portfolio, and let's imagine that the risk weighting of that portfolio, for simplicity's sake, is say 60%. That means that there's 600 million of risk-weighted assets associated with that portfolio. And let's imagine that you can satisfy this significant risk transfer test by transferring, let's say, 60 million of credit risk associated with that portfolio to a third party. If that transfer of risk satisfies the significant risk transfer test, you can see that the risk weighting that the bank can then apply to the retained $940 million of notional drops to 15%, which results in RWAs of 141 million now being associated with that portfolio. So if you look at the transaction pre-SRT or pre-significant risk transfer, you have 600 million of RWA associated with it, and then post-SRT, you have 141 million RWA associated with the portfolio, which is quite a significant reduction, as you can see from the very simplified calculation I put in. And one point to highlight on this slide, this is the numbers are very, very simplified, and I haven't done the full capital calculation here. Hopefully you can see the principle at play, and you can see how powerful these transactions can be from a regulatory capital perspective. If you look at the risk weighting on the first loss tranche, as it's quite often called, this is the risk that has been transferred to the counterparty. The risk weighting I've assumed there is 0%. Now, the reason for that is that historically and traditionally, the counterparties that have executed these transactions haven't been insurance companies, at least not insurance companies using insurance policies as unfunded protection. They may be asset managers, hedge funds, investment funds. Now, these guys aren't rated and they perhaps don't have the same balance sheet strength as an insurance company. So it's been market practice for a counterparty providing the credit risk transfer on these transactions to collateralize their protection. That means they will write a guarantee and then they will effectively post, in this example, $60 million worth of cash collateral into a ring-fenced account. Now, under the CRR, the risk weighting associated with fully cash collateralized positions is 0%. So that's just a note to explain the 0% risk weighting there. Hopefully that sets out very simplistic level some of the intuition behind these transactions, and you can see the significant capital benefits that these transactions can realize. And just to elaborate on the intuition, if you go to the next slide, Celia. If you step back and you look at the whole reason why banks hold regulatory capital in the first place, well, the regulatory capital under the IRB model and the Basel models is really set up to withstand a given severity of losses. And the model used originally in the Basel papers was something called the asymptotic single factor risk model, which effectively sets that the level of expected losses, or sorry, unexpected losses that banks need to hold capital for at the 1 in 1,000 level scenario. Now, if you imagine that the reason, or if you accept that the reason why you're holding capital is to withstand this given level of losses, then if you've transferred the significant credit risk from which those losses could arise to a third party, then logically, the reason why you're holding capital in the first place is less relevant. Hence, if you can achieve significant risk transfer, you can achieve significant RWA reduction. And the reason why the reduction is, you don't have a 0% risk weighting on the senior tranche is that you can never imagine a world where a full limit loss across the entire portfolio is not a possibility. So there's an element of prudence built into the framework, but the regulatory capital savings are still very compelling for banks, and that's why they have executed these transactions for the last number of years, and the market has really started to grow. If you go on to the next slide, please, Celia. So that hopefully gives you a sense of the intuition, the rationale behind these transactions at a very, very high level. I just want to talk about some of the key features of the market absent insurance, because the insurance market is effectively plugging into a pre-existing market. And I think part of the job that we have as a broker, and underwriters as well have, is to really look to bridge the gap between the existing features of the market and what works for the insurance market. So if you look at the traditional counterparties on these transactions, they've historically been hedge funds and asset managers, although the structures I outlined are pretty much the structures that they're executing the risk transfer in. So rather than writing an insurance policy, you might have a hedge fund that will come along and say, we will provide you with a guarantee, and we will collateralize that guarantee with some of our cash, and the bank will achieve risk transfer through that arrangement. Now, historically, the credit protection instrument has been a credit default swap or a financial guarantee. What's the reason for this? Well, one of the main reasons is that hedge funds and asset managers are generally not licensed to write insurance policies. They don't have the relevant regulatory permissions. So when you actually look at the documents on a live transaction, quite often what you will see is that the legal advisors to the counterparties, being the hedge fund or the asset manager, will write a regulatory opinion where they have to, I guess, thread the needle and say, this document, which responds to fortuitous losses on a credit portfolio, is not an insurance policy. Now, they can do that because of the distinction that is generally drawn between, say, a CDS and an insurance policy. Obviously, that's never an issue for insurers because they are licensed to write insurance in the jurisdictions where the bank clients operate. Now, I mentioned that traditionally the protection that was provided on these portfolios was collateralized. This is for a number of reasons. So one, the counterparties didn't necessarily have the same ratings or balance sheet strength as insurers. The other reason is a lot of the investors in this space have been hedge funds and asset managers. So they're generally cash rich. They raise cash from their investors. And cash is also risk weighted at 0%. So it makes the transaction efficient from the bank's perspective. But stepping back, there have now been transactions executed with insurers where the protection is not collateralized. That's really a feature of the pre-existing market practice, but it's not a necessity going forward if, for example, the counterparty is an insurance company. Now, if you look at some of the key features that you have on these transactions, you need to remember that these transactions are often portfolio transactions. You have multiple obligations referenced in the credit protection. The way that works is you'll get a very extensive Excel spreadsheet called a data tape, but the pools or the portfolios are often blind. Now, when we first raised this idea of blind pools with underwriters, it can result in them breaking out in cold sweats, because I think the initial idea that people might have is that the bank gets the benefit of credit protection, and then at some point in the future, if they have a loss somewhere in the balance sheet, they will call the underwriter and say, well, you need to pay the loss here. And it's absolutely not how this works. So there's a lot of discipline and rigor around these data tapes. The reason why the portfolios of the pools are often not disclosed, it really depends on the size of the pool. If you look at, say, an SME portfolio, you could have 2,000-3,000 financial obligations referenced in that portfolio. It's simply impractical for the bank to go and waive confidentiality with all the obligors and disclose all those underlying obligations. And frankly, the benefit that's derived by the counterparty from seeing who those names are is de minimis. I think it's generally accepted that if you look at a portfolio and you start to get above 100 to 150 names, the way to model that is on a stochastic basis, and it doesn't really make sense to underwrite each loan on a name-by-name basis. So that's the reason why the pools have historically been blind, because they reference a large underlying pool of diverse obligors. That said, there are transactions where the pool will be fully disclosed. It really comes down to what's called the granularity of the pool, which speaks to how many obligations are in the pool. And if you have, say, a transaction like one that was closed towards the end of last year, where you had around, say, 130 names in the pool, well, that's a very different conversation with the bank, and it also makes much more sense to look at the exposure on an individual basis. Part of the kind of the discipline and the rigor around having these portfolios that are executed on a blind basis, that you have eligibility criteria. So these will dictate the percentage of the portfolio that can be exposed to a given credit rating, a different sector, a different type of obligor. And these are negotiated on a case-by-case basis with the counterparties. There's also a risk retention on these transactions. So the minimum required regulatory risk retention is that the bank must retain a minimum of 5% of the net economic exposure associated with the underlying pool, but this can be as high as 20%, depending on the pool and what's agreed. Another point to bear in mind is the loss payments on these transactions. If the counterparty is writing a CDS, well, the credit events that the CDS responds to are failure to pay, bankruptcy, or restructuring. Now, while the pool is blind, you also have the benefit of a verification agent mechanism, whereby usually one of the, I think it's the big three or big four accounting firms is appointed as a verification agent, and they will go in, and if you have a credit event, so a failure to pay or a bankruptcy, they will look at the underlying obligation, check that the amount being booked as the loss amount is correct, and it reflects what is actually being booked in the bank systems. The key point to take away is that while the credit protection may be a CDS, it actually still follows the fortunes of the bank in the same way that you'd expect an insurance policy to do so. I think people, when you talk about having CDS style credit events as a loss trigger, there's a fear, I think, particularly from underwriters who are new to this space, that somehow this could result in a gain to the bank, and that's absolutely not the intention, and it's never really the result of the transaction. These transactions are called risk-sharing transactions because the idea is that the losses are shared between the parties, and it's not some kind of, I guess, trade where the bank expects somehow to be able to make a gain. Operationally and practically, these transactions operate along the same principles that an insurance policy will operate, i.e., the risk-sharing partner follows the fortunes of the bank in respect of the underlying exposure. Final point is that you get on a lot of these transactions replenishment periods. If you think back to one of the earlier slides, you saw that the risk weighting that is achieved on the senior tranche is what really drives the regulatory capital benefits of these transactions. Now, if you imagine a portfolio amortizing, that senior tranche, depending on how the amortization works, that's going to reduce over time. Now, if you put a lot of work into one of these transactions, you want to maintain as much of the regulatory capital benefit for as long as possible. So people will agree replenishment criteria, which dictate what obligations can be added to the pool and in what circumstances they can be added to the pool. And this works well both for the bank because it maintains the regulatory capital efficiency of the bank's transaction, but it also works well for the counterparty because as the transaction amortizes, the limit of the credit risk transfer provided by the counterparty will also begin to reduce. So it preserves the returns for the counterparty to these transactions. If you just go on to the next slide, please, Celia. So I talked very much about how the existing market works. And so the question could be asked, well, why does insurance play a role? I think insurance really started to gather pace when there was talk of the revised securitization framework coming into play. Now, this was implemented as of 2019. That did a number of things. So one, it increased the lowest attainable risk weighting on the senior exposure from what used to be 7% to 15%. So these are still highly efficient transactions from the bank's perspective, but the regulatory capital savings have been impacted as a result. The new framework also amended some of the regulatory capital provisions, which effectively meant that for the transaction to be as efficient as possible from the bank's perspective, thicker tranches of risk would need to be offloaded. This meant that on some transactions, for some portfolios and some asset classes, there was an opportunity to transfer an additional layer of mezzanine risk. Now, this mezzanine risk is less attractive to traditional investors, but it's much more compelling for insurers. And this was where, certainly when I was an underwriter before I joined Texel, and this is an area I was looking at, and this is where these transactions really started to make sense for us. The mezzanine risk is attractive to insurers because if you look at how the investor universe is generally divided in the funded space and in the structured credit world, you have two broad camps. You have funds, that may be hedge funds, that are very comfortable with taking risk, but they want to get paid handsomely for taking that risk. And then you have large institutional investors who perhaps prefer much more conservative, very senior, stable returns, and they're happy to get paid far less than, say, the funded investors might be paid for the first loss position. And this opened up a slight gap because if you look at the typical pricing on a mezzanine tranche, it's generally not enough to get, say, a hedge fund excited, and it's probably too close to the risk for, say, a very conservative large institutional investor. But in terms of risk profile, overall implied credit quality, it's very much in the sweet spot for insurers and can price and pay attractively. That said, that's where the conversation really started with insurers looking at the mezzanine risk. However, we were, I was certainly looking at this area maybe about 5 years ago. And as kind of things have evolved, we've seen people start to look at taking the equity risk. And so a number of transactions have now been executed with insurers, not taking the mezzanine risk, but actually providing first loss cover on a portfolio. So this is kind of where the market has begun to evolve. Now, I wouldn't say that's generally reflective of the whole market, but it shows some of the appetite that is beginning to develop in the insurance market for these transactions. But if you step back, a key point I really want to bring out, and hopefully that I've been able to highlight in this talk, is that if you look at a synthetic securitization, it's kind of a natural evolution of the risk-sharing partnership that already exists between large credit insurers and their core banking clients. And so, Celia, if you go on to the next slide, please. What I've tried to bring out here is how an insurer may work with an investor and with a bank. If you imagine the same $1 billion loan portfolio, well, you could have the traditional investor taking the first loss position, and then you can have the insurer sitting excess of the traditional investor. And that's attractive for a number of reasons. I think from an underwriting perspective, you effectively have three sets of eyes going on the risk. You have the bank who's originating the portfolio, and the exposure going through their credit underwriting team. Then you have the first loss investor who is taking the first losses on that portfolio. And they scrutinize the portfolio, make sure that works and makes sense from them. And then you also have the underwriter taking a look at the portfolio as well. So these transactions can make a lot of sense and can be attractive to insurers who are willing to really open their mind and look at them. And if we go into the final slide of my section, I think the point I really wanted to bring out is, on the previous slide, I showed how the insurer and the investor are effectively doing the same thing, offering risk transfer to the bank. Here, I just wanted to highlight, some of the key similarities and a few of the differences that you have. So if you look at a traditional SRT transaction and a traditional credit insurance policy, well, you have a transfer of credit risk happening in the both approaches for a regulatory capital benefit. The approach is very much one of partnership. Traditional investors will work very closely with the banks, really understand their processes, their systems, their franchise with regard to their particular portfolio, their track record, their history in, say, trade finance, SME lending, whatever it may be. Both are well-established core bank tools. But what I've found over the last few years is that the teams perhaps responsible for, say, insurance distribution and the teams perhaps responsible for SRT transactions in various banks don't always know about the existence of each other. In some cases, they definitely do. In other cases, they don't. And what we found is that there's more conversation happening between these parts of the banks, because you can see how, I guess from a first principles approach, what both teams are trying to achieve does have a considerable degree of overlap. Form of protection, CDS or financial guarantee on an SRT transaction. Obviously, for insurance transaction, it's an insurance policy. Some insurers have executed instruments that are similar to unfunded risk participations. And if you look at the underlying risk, ultimately it's credit risk. And while I think the insurance market focuses much more on a single loan type exposure, ultimately, if they've been in business, for a sufficient period of time, where they ultimately build to is to build up a portfolio that they would hope is representative of the banks that they're supporting. They would have to build a portfolio that is representative of the bank's portfolio without cherry picking of assets. And I think that's a position that these transactions can put insurers in from day one.